I often get quite a chuckle when someone I begin to talk with tells me that their portfolio is either at Schwab or at Fidelity because it's free. Now, one of the things I'm going to tell you folks and clue you in, folks, is that these major financial institutions and mutual fund companies can't buy commercials every 15 minutes on major networks, nor can they sponsor sporting events like the NBA, Major League Baseball, and the NFL, and even the Olympics by doing business for free. Now, when it comes to the management of your portfolio, it is important for you as the investor to understand that we can't realistically control markets. Markets are random and they're unpredictable. Now, there are two things that we can definitely control and control well, and that is cost and risk. And today we're going to concentrate on cost and the biggest myth, which is what you don't see can't hurt you. Now, an unfortunate reality of many investments is that fees are either not clear or not fully evident. I like to compare fees to an iceberg. And as you can see here, this is the water. And in an iceberg, there's the top of the iceberg, which is you can fully see. And then there's the bottom of the iceberg, which is underwater. That can be big or small. And that is the part that is hidden. So I like to say to look at it as visible cost and invisible cost. Now, the costs that are up here, those are costs that are easily seen. Okay, you can open up the prospectus, and those are called expense ratio, and the average Morningstar expense ratio for a fund is anywhere from 1.25% to 1.5%. Now, some funds have upfront commissions, okay? So those range from anywhere from 3% to 5%. Now, the commissions are upfront. Some funds have them. They're called loaded funds. Some funds don't. They're called no-load funds. Now, however, let's take a look at the part down here. Okay, now the part down here is the hardest to see. Okay, these fees are a whole different story. These fees are detailed in a document called the Supplement of Additional Information, which, by the way, the fund companies don't actually have to provide this to you. You actually, they're under no requirement to provide this to you. Of course, you have to call yourself in order to get this information. The funny thing about this information is that most investors don't know anything about it, and most financial advisors don't even know anything about it. So the first cost that we have to understand in this bottom part here, okay, is what's called turnover cost. And this is what this basically means is the portfolio manager buying and selling stocks in your portfolio. Okay, and for the most part, Morningstar shows that the average turnover of a mutual fund is roughly 100%. Okay, now the turnover not only takes into account, again, the spread of the buying and selling of the stock, because of course you know that you can't buy a stock for the same price that you can sell it. There is what's called a spread. Okay, the average turnover, again, per Morningstar is 100% in any one mutual fund. The other thing to understand is that there's transaction costs involved in that buying and selling. Folks, no matter who you are, nobody trades for free when it comes to investing. So together, the turnover and the transaction costs, you're talking about another 1 to 1.5%. Now, if this is in a taxable account, well, of course, you have to include the cost of taxes to your portfolio. And in the taxable account, that can account from anywhere from 2 to roughly 3%. Okay? So as you can see, yearly costs in your portfolio can very easily add up to anywhere between 5 or 6% a year. And if you paid a load up front, you add another 3 to 5%. So, for instance, in the first year, assuming you paid a load up front, you have to generate at least 10% in gains in your portfolio just for you to be able to break even. So when it comes to investing in these expenses you pay, those fees are subtracted from your returns. So in this case, you do not have to, you don't actually get what you pay for, since there is a lot of cost in a typical portfolio. Now, when we do a portfolio MRI, for someone when we review their portfolio, and a portfolio MMR not only takes a look at the interior of the portfolio, but it takes a look at the expenses of the portfolio. It is not unusual for us to see expenses that range upwards of 3% or higher. If the portfolio is inside of variable annuities or the portfolio is inside of 401ks, quite often these fees are even higher. Just recently we reviewed a couple of portfolios, one about $750,000, one about $1.3 million, and found annual costs inside of these portfolios of between $23,000 to $39,000. Okay, if you spread this cost out over 10 years on the $1.3 million portfolio of $39,000 a year, that's close to $400,000 in expenses, and that's of course assuming no returns at all. Okay, so the big thing we have to be aware of is that no one invests for free. Okay, we know that. Nobody invests for free. There will always be a cost. However, you must understand that we need to lower that cost. These costs of 3, 4, 5, 6% are too high for our portfolio. Okay, so in order to do that, we have to make sure that we have a globally diversified portfolio of index or structured index funds and get away from any financial advisor or money manager that speculates, gambles, and market times with your portfolio. This is the right approach, and this approach will cost you less than 1%. Okay? 1%, lower than 1% cost of your portfolio. So guys, do it right. And I'll see you next time on Financial QB TV.